Welcome to Montana's Commercial Real Estate Podcast. I'm Julian.Scurci here with my colleague Daniel.Miller at SVN Pure West, Montana's only commercial real estate firm that possesses both local knowledge and a national network. We decided to build this podcast because we both believe there is a tremendous opportunity in Montana, and we're surprised that there was not a show that interviewed business leaders, policymakers, and regional experts. This show seeks to be an exploration of the state of Montana's real estate market, business environment, and serve as a learning opportunity for us, the guests, and the audience.
Welcome, listeners, to the second episode of the Montana CRE Insider, Montana's #1 commercial real estate podcast. My name is Julian.Scurci with Montana SVN Pure West. I'm here with my colleague, Daniel.Miller. We are very excited to have a robust discussion today on everyone's favorite topic, taxes, and how to minimize your taxes or utilize real estate as an asset class to take advantage of various tax deductions. We're going to have a lively discussion about taxes. We want to stress that neither of us are accountants, neither of us are tax lawyers. Please consult your own investment professionals. This is for informational purposes only. This is just to be an overview of recent changes in the tax code, but something that we've been getting a lot of questions on from our clients and that we wanted to share. Daniel, my friend, how are you today?
Doing very well, very well. So head is spinning a little bit for trying to, taking the past month of trying to understand this whole new beautiful bill and tax implications it is. There's a lot of reading. I think through the storm and trying to drill down on everything that it involves.
Nice. Yeah, and we should also stress too that there's a lot of implications of the new tax bill. We're not making political comments on are these good policy or not. We're taking the world as it is. There's a lot of things that again you can dig into more with your own homework, but we wanted to at least give folks an overview to know what tools are available to them with real estate as an asset class and how that can be tax advantage for their own investment decisions, their own procurement of real estate, and maybe other decisions they're making for how they choose to conduct their personal investing or business investing.
Right on. Exactly. Couldn't have said it better myself. Yeah. We are not CPAs. We're just telling you our opinions and what we interpret what this bill means.
Yeah, absolutely. So Daniel, where would you like to start? What was something that jumped out at you as a topic that either you found interesting or a big change of note, or is something that you've been getting a lot of questions on from clients?
We've got to eat our vegetables before we have our dessert, right? Before we get to the good stuff, let's start with some and cost segregation and see what the mechanics look like with this new bill. One of the newest things is it's gonna let you go 100%, which that was starting to get graduated down over the past several years, but now we're back up 100%, which is great. It's great, and it's going to be permanent. Obviously new laws that come into effect here in the future that can change, but as of right now with the new bill, that is going to be permanent. So I think that's a huge plus for our investors and our business owners in Montana. And I think that's something that really needs to be paid attention to.
Yeah, it's a great point. And I've been getting this question a lot from some of my clients. So let's discuss what depreciation is for a bit. So you think about an investment in real estate, you have the cash impact of it, and then you have the non-cash tax impact of it. So, depreciation, the best way to think about it is it's a way for you to take down the value of a useful life of a property and the improvements that you're making in the property, and extract that value against any sort of earned income or earned cash flow that you're receiving from that investment or elsewhere in your life from other business activities. So where this can be really useful is if you're buying a property that needs a lot of rehab or needs to have a lot of value add investment to bring it up to its best best operating performance where it can get its highest rents. Or if you're a business or investment fund or individual that's earning a lot of income elsewhere in your life, you can now take 100% of all those activities and repairs, all those costs for that property. You can take it up front. So, that kind of deduction and depreciation might offset taxable income elsewhere in your life or in your business. And that can really mean that you're paying a much lower tax rate or have less taxable income, on your on what you're being charged by the government.
Right. Yeah. And one thing to remember with this is this doesn't include or encompass anything structural. So nothing with actually building structure, but you can do renovations inside the building. It's not going to include in addition to the building. It's pretty much tangible property. However, for what we're seeing, it does include if you're going to do improvements to like parking lots, so parking lot lighting, parking lot resurfacing, it's going to include that type of stuff. Anything structural, anything permanent, and it doesn't include land either with the building. So that's something we're interpreting out of it. Obviously, get opinion from actual professional on that, but that's what we're interpreting that's coming from this bill. And when it comes to tangible property, it can be new and used as long as it's your first use. So it can be used piece of property as long as it's your first use and you're claiming for the first time on your taxes.
Those are great points. And yeah, we should stress you can never depreciate land. It always has to be an improved structure. Land can't be appreciated because land is permanent, right?
Exactly. Yep.
Yeah.
They don't make any more land, that's for sure.
That's true. Who said that? Was that Roy Rogers? That's what I like about real estate. They don't make any more of it.
Unless if you're Dubai, they're making their own islands down there, but we're not doing that around here. That's too much for us.
I guess that's the exception, right? We're not doing Dubai real estate.
Right. So Julian, tell me how do we figure out the cost, the bonus depreciation? I always read things about cost segregations. So what's the difference between a cost segregation and bonus depreciation?
Yeah, my understanding and how I've utilized it in the past for either my own investment properties or with clients is that there's a lot of firms that can be either accounting firms or specialized consultants that will do cost segregation studies. And the real key here is that you have to itemize all the work you're doing for property. And then with that totality of all the costs of the work that you've done, you can lay out and submit a report for these cost segregation studies that allows you to do the depreciation for 100% of all that work that was done. So there is a process involved, and eventually we should know too that again, a lot of this is, we should make the distinction that this is a tax impact, not necessarily the cash impact of the property itself or the performance of the property. But if in the event of sale, there can be things like depreciation recapture, so that you perhaps have your capital gains adjusted at the event of sale for a property, and that's where the cost segregation studies really come into play, because you can point to a third-party professional independent evaluation of, hey, IRS, here's the work that I've done for the property. Here's a legitimate depreciation that I took, and here's how it should be offset when calculating what my actual capital gain is on this investment.
Okay, so for the listeners, the cost segregation is the study and the math equation, and then the bonus depreciation is the actual tool you're using to notify the government of the claims you're going to make on your tangible property.
Very well said. That's my understanding as well.
Perfect. So now that leads something that kind of goes hand in hand on that I want to talk about is the changes in Section 79. which is it's a much more itemized where cost segregation and bonus depreciation is pretty much the sledgehammer. You're taking a huge chunk and you're using that to not defer your taxes, but to lower your tax impact. Where Section 179 is more like a scalpel. You can kind of pick and choose which tangible property that you want to use to offset your taxes.
Right, and that's one that I don't have personal experience with, Daniel, either as an advisor or as an investor. What would be some examples of how someone would choose particular items for 179, and why perhaps would they go that route versus the larger depreciation or cost segregation route?
I think you can, from what I understand and from what I've been told by some different CPAs, first off, changes and it's raised up to $2.5 million, and it applies per tax year per taxpayer. So you can pick and choose which tangible property that you want to deduct from your taxes to make that tax year as a zero basis. You never go into the negative you can't go in the negative, but you can carry forward if you want to. From different CPAs, we're not going to get into it because I'm not a CPA, but they're telling me that you don't want to make your tax basis zero on a finance vehicle or a lease vehicle. You don't want to do that. There's different tax implications that you could run into with that. And you can also use that in conjunction with your bonus depreciation to affect whatever taxes that you want to pay at the end of the year, to help offset your tax that you pay at the end of the year. And we can get into that, a little bit here in the future if you want to.
Yeah, that's a great point. I think a lot of these decisions and tools that we're talking about and aspects of the tax code, really why it's so important for an individual to consult with their CPA, with their tax advisor, with their financial advisor, to think about what's the best strategy available to them for their personal circumstances. I think that's something that we want to stress here, is that you're having a range of tools and options. How are you best utilizing that menu of options to both lower your overall taxable income and maximize your investment gains?
Right. And I think a big thing to remember here is both of these can be carried forward to future tax years. Or if you can't write off enough taxes, or you're paying a zero tax basis this year, you can actually carry forward to next year. So if you want to look up and you want to write that off in taxes, you have to figure out how much I need to borrow, or how much property do I need to do purchase, and then you carry that. Then you can write it off this year and next year and bring your tax base as close to zero as you can over the next couple of years.
Great point. Yeah, and that's particularly important for businesses where real estate's a big component of their investment operating issues, whether it be a franchise-oriented business, whether people are making decisions to either own their real estate or lease their real estate. Those are all decisions that would have implications for the discussion we're talking about.
Right, exactly. So how do you feel about opportunity zones, the changes?
Opportunity zones, I think, are really exciting. I think that's probably, perhaps the biggest policy implication for real estate, for a unique vehicle and policy apparatus that allows reinvestment in more either rural or urban communities that want to have investment encouraged for raising those communities up, and it also allows an elegant way to encourage investment into these communities. So maybe we should take a step back and talk about what opportunity zones are. So the U.S. is actually divided into, we think of maybe U.S. is divided into different zip codes or different states and regions. If you look at U.S. Census data, there's actually something called a metro statistical area, or an MSA, and it isn't necessarily include one county. It doesn't necessarily include, one metro area. It can include, kind of a combination of different zip codes within a region. But the way that opportunity zones are created is policymakers and legislators went through all the different census MSAs and said, what are the communities on either an urban or a rural level that we want to encourage investment in, that we can try to help rise up these communities and bring in business activity, bring in investment dollars to make these communities more prosperous. And the way they decided to do this is by creating the Opportunity Zone Act. So what this broadly entails is that if you're an investor and you either invest in real estate or an operating business within these designated opportunity zones throughout the entire U.S., and Montana has a few of them. There's actually some really cool maps that you can just use on the internet. If you Google opportunity zones, it can show on a map, by state, by area, where the boundaries are for these. But broadly speaking, and Daniel, please correct me if I'm wrong, the two key features to think about are, one, all opportunity zones are now encompass places that are only 70% or below of the median income of those MSAs. And then the second point is, and this is really the important part from a tax perspective, is if you're an investor and you invest in a project that's within an opportunity zone and has been designated as an opportunity zone project, if you invest for 5 years, you have 10% of your gain eliminated from a capital gains perspective. But if you invest for 10 years, if you lock up that investment for 10 years, you get 100% tax-free gains on the investment outcome for being involved in that opportunity zone project. And the new legislation in the Big Beautiful Bill made this permanent. That's my interpretation of this. That's how I've had friends who are opportunity zone developers as well as CPAs describe it to me. But Daniel, what do you think of my interpretation? Or is there anything I'm missing there?
No, you're absolutely correct. The couple of things you need to watch out for while doing it, from my understanding, is it has to be done through a qualified opportunity fund. So you just can't go in and purchase a building or build a building yourself in one of these zones. It has to be gone through a qualified opportunity fund, because there's a lot of background checks, a lot of things that they go through for that. And typically, they're going to want you to substantially improve that property. And then another thing to remember is these, starting in 2026, state is going to start identifying zones, and that will be in place January 1 of 2027. So I think we're going to see a lot of pullback from people investing in these zones throughout the next year and a half, waiting for the new zones to establish, because there's going to be new areas. I think the areas will remain the same, but the boundaries are going to slightly change, because with this new bill is they're getting rid of the contiguous tract. So what that means is you have a tract that's an opportunity zone tract. You can invest in the neighboring tract as long as that median household income isn't above 125% of the average. That's going to get rid of that. So I think there's going to be a lot of shift in it. It's going to bring more money and more development into, I think, better needed areas, which I think is going to help out with the economy a lot, and just help out with people in general. But there are a couple things to keep in mind with that. You just can't go and buy a building in an opportunity zone and think you're going to get all these tax savings. You have to be part of a fund.
No, that's a great point. And I have some friends that are steeped in this world where they're opportunity zone developers in Montana, in other parts of the country, where they've set up these funds, and they are have a business model to accommodate investors in their projects that are looking for that kind of tax deferral, tax advantage strategy. And I think that's a key point that we should discuss. Is this is really in a pragmatic manner. This is not only is it a great tool to get reinvestment into these various communities, but it also is a vehicle that allows folks who've maybe had a big windfall gain from selling stock, from selling a business, from selling other property, and you're trying to, do a tax deferral in a case of 5 years, or a, big tax deferral and big tax mitigation if they go the full 10 years. That's where these opportunity zones become really attractive, is, for folks that have had those gains and are looking to, shelter or mitigate the taxable impact of those gains.
Right, for sure. And another nice thing too is another attraction is those investors that are kind of, getting tired of managing properties and getting tired of the hustle and bust. They could put their money into this fund, sit on it for 10 years, not do anything, and just kind of relax and, finish out their career as a real estate investor and just kind of wind everything down. So it's a nice exit to someone that's had a big portfolio their whole life.
Yeah, and that's a really good point. And again, I think pragmatically, or where you see this as a common situation, there's a pretty good parallel to something that's been around for a while, and is a big feature of the tax advantages of real estate investing, but is the Section 1031 exchanges that maybe our audience is familiar with, or that Daniel and I have a lot of experience doing as both investors and advisors. But maybe we should speak to that a little bit, because that's a very common existing tax deferral tool involved in real estate. The broad outline of that is really that if you sell an investment property, you have 45 days to identify up to 3 like-kind replacement investment properties that, if you close on within 180 days, you can defer any capital gains on the property you sold if you purchased that replacement property within the timeline I just described. And that's, a lot of times people do that for different reasons. They maybe have a partnership that breaks up, or they want to sell one property and move it into a different property. And we should stress that like kind can be everything from someone selling an apartment building and then buying an industrial building. As long as it's commercial real estate and it's not residential, the definition of what's like in kind can be quite broad. But it also, you see a lot of it, and this is where I mostly work with clients, is you see it when people want to move from active management of investment properties to more passive management, or properties that are easier to manage. So they might sell an apartment building that they're actively managing in one state, and then they purchase a commercial property that's on a net lease that just provides straight income without much management intensity, or they work with someone else who's actively managing it for them. But that's a tool that people utilize when they're in later stages of their life, or want to move from more an active investor to a passive investor. That's how I commonly work with clients. But it's something that everyone should be considering to take advantage of, because you could theoretically do 1031 exchanges over 10 properties throughout your entire life and never pay, and keep rolling that and never have a taxable event till much further in the future.
Right. You're exactly right. And another time frame to remember, and that is you have the 45-day identification period, and then you have the 180-day closing period. So you want to try and close that property in 180 days. And a question I get from a lot of my clients is they're unaware. I just assume this, but they're unaware that you can do 1031s across state lines. So that is completely available to people. Don't think you have to like kind means in the same state under the same state government. You can do it across state lines.
Yeah, and it's such a great point, because one of the reasons that we like Montana and why we're doing business there is that we live in a big, beautiful country, 50 great states. They all have their own individual tax codes and state tax policies and business environments. But Montana really benefits from a relative basis compared to some other states of being more business friendly, more tax friendly. And if you could, if you're someone who lives in a high tax state like California, you sell a property that maybe you're earning 7% on there, but you have a 13% state income tax rate. All of a sudden you're selling a property and you're earning a higher yield in a state like Montana. Even if you're still a resident of California, your after tax income is, you're going to get a better yield for that, for owning a property that maybe has more upside appreciation and produces a better after tax yield for you in a different state. So that's how I think a lot of sophisticated real estate investors are utilizing the gamut of opportunities and looking at things, where's the best bang for their buck in the entire country, but particularly in a state that's got great demographic growth and great business growth and policy backdrop like Montana.
Right. And great. I appreciate that was a great segue into something else I want to talk about. We could just barely touch on this because it doesn't really have to do with Montana real estate before we get into my cat's meow, which I'm excited about. But you mentioned something about selling a property and paying taxes in California. So what do you want to talk about? What do you want to say about the SALT deduction, state local taxes deduction that just got passed?
Yeah,
or just got actually increased.
That's a great point. So SALT, as you noted, stands for the acronym stands for state and local taxes. So I believe, correct me if I'm wrong, in the original tax legislation during President Trump's first term in 2017, they brought down the amount of deductions you could take for paying your property state income taxes and state property taxes to a lower threshold. And this really impacted folks who are living in higher cost states with higher property taxes, particularly on the coast. So in this new legislation, this big, beautiful bill that just passed, I don't think they brought it back to quite the pre-2017 levels, but they brought it to a point where you are allowed to have higher deductions. So, this benefits people that live in high tax states that have high home values, high property taxes, high state income taxes. Obviously, those are all very individual situations that people need to navigate, but it's another tool for them to utilize real estate to minimize their overall tax impact.
Yeah, and I think they actually did raise it from 2017. So it was capped at 10,000 before this big, beautiful bill. They actually raised it up to 40,000. And that can be used across multiple states as long as you don't exceed that $40,000 tax write-off. So what that means is if you're paying, say you're paying $60,000 of income tax, state income tax in the state of California, you can take $40,000 of that and write that off on your federal tax. If you're paying $20,000 in California, you're also operating businesses and you're getting income in Texas. I don't know if Texas has state income tax, and you're also paying $15,000 of state income tax in Texas. You can write off $35,000 on your federal income tax. So you can use that across whatever states you're actually paying income tax on, which is really nice. I think that helps people out. There's a lot of hubbub. Some people are upset about, people that are paying more income tax in these heavier tax states, they're getting more of a benefit. And me, my primary residence is Florida. We don't pay state income tax, so it doesn't benefit me at all, unless if have income producing businesses in other states. But I don't care about it as long as it helps out more people. That's what you should be happy about. You shouldn't be upset that you're not getting a better deal than other people. But that's my opinion. Don't attack me for that. But I think the more, the better good for the more people is what we're trying to do here.
Absolutely. Yeah, I'm not going to attack you for that, Daniel. You'll see no attack from me here. But look, taxes are complicated. You're never going to make everyone happy with some of these policy changes. We take the world as it is, not necessarily how we want it to be. We're just trying to arm people with information where they can help navigate their own personal situation with their own advisors for what's best for them. And we're just trying to be a resource. This is supposed to be an educational program, and we're here to take your listener questions, and we're here to provide information that will help you make good decisions. Exactly.
Without showing our asses too much. Keep that to a minimum.
Yeah, totally. Exactly. To a minimum.
My favorite thing on this whole deal is the qualified production property. So, Julian, you familiar with the new qualified production property part of the bill?
This is not one. This is not one that I'm steeped in. Maybe you could elaborate for the audience on what you like most about it.
Definitely. So this is something new in this bill. It's trying to bring back manufacturing jobs to the United States. What this encompasses is if you start construction after January 19th of 2025 of a production facility, so we're talking mainly industrial, you're producing products, you're storing products. This can actually, I believe, don't quote me on this, but be translated into shipping. So like FedEx, UPS facilities, Amazon facilities, you're storing products to ship out. If you begin construction after January 19th, 2025, and you place this structure, this property into service before January 1st, 2031, you can write off 100% of the building on your taxes. 100% of the cost of the vertical structure. We're not talking the land, but all the underground and the vertical structure. You can write off 100% of the cost of that building in your first year of putting that property into service, which I think is huge. I think it's going to spur a lot of construction manufacturing. I think it's going to spur a lot of people moving over to the industrial sector to start new jobs. And I think it's going to bring a lot of production and workforce into areas that need it. So I'm really excited about this one.
Yeah, that's a great point. I mean, just like the opportunity zones, you can kind of see what the policy making goals are of some of these legislative changes. And it's to both, in the case of what Daniel's just talking about, really the idea of reshoring supply chains and encouraging more domestic manufacturing and production in the reindustrialization of America. I think that has really big implications for our economy and also for real estate, particularly for industrial real estate, which is an area that Daniel and I both spend a lot of time in. The way that supply chains are going to be reoriented and how that impacts the need for industrial real estate, whether it's small bay industrial properties that are multi-tenant, or what you would call transmodal industrial, where and Montana has a lot of this, where there's a lot of rail links to properties, as well as key trucking exchanges or interchanges. Obviously, they're not necessarily ports in Montana, but Montana is being a big commodity producer and a big mining state. There is a lot of shipping by rail of raw materials and also of end manufacturing and processing of those materials within the state, and makes it a pretty key logistics hub as materials are shipped across the country, whether for import or export. So I think this is an area, again, that I'll be watching. I'm excited to see what kind of reindustrialization investment activity this spurs and the implications for where it makes sense to own industrial and where businesses want to find more space to reorient their supply chains.
Right, absolutely. And you do have, in some of these areas where these investors want to build some of these buildings and bring some industry to the area and provide new jobs. But with construction costs, they're through the roof right now. I don't know how they are in California, but they're over the Southeast, they're through the roof right now. And I think with this 100% tax rebate, that the write-off that you have on it, I think it's going to make paying those construction fees a little bit more palatable for people to go out there and want to take on these projects.
Yeah, great point. We want, you at the end of the day, we're both pro-business capitalists who want to see the encouragement of, business and investment activity. Real estate, usually is a derivative of economic and population growth. So if more investment activity is happening in the U.S., that generally leads to more demand for real estate, which is exciting.
Yeah, absolutely. That's all the banter I have. Is there anything else you want to touch on this bill? Anything new that you want to reach out on without getting us in a pickle? And with the CPA.
I just want to apologize to our audience. Hopefully they didn't bore you to tears. I hope your people are still listening. They didn't tune out for, a half hour of tax discussion. Hope you found it informative. We're trying to be informative, but also entertaining. I know this is, somewhat dry subject matter, but it is important. We're getting a lot of these questions. We appreciate your feedback for the audience. We appreciate hearing from our listeners if there's certain show topics that you want us to address, or if you have follow-up questions. I think we're also at some point going to have a professional CPA and tax lawyer on as a guest to go through these in more professional detail. Again, we want to stress, Daniel and I aren't the experts here. This is just our interpretation and highlighting some of the big changes that are happening in the tax code. But yeah, I hope no one fell asleep during our conversation. And I hope if you were bored by it, that you'll tune into another episode where maybe the material is more exciting for you.
Absolutely. And if you guys want to drop us a line or ask us questions, there's a Julian.Scurci on LinkedIn and Daniel.Miller on LinkedIn. And you can reach out to us through svnpurewestcre.com.
This show is for information and educational purposes only. It is not a solicitation to buy or sell real estate, securities, or any other investment. The views reflected in this show are solely those of the hosts and guests and do not necessarily reflect the views of SVN Pure West, SVN Inc., or any other business or organization mentioned. If you'd like to contact the show's hosts, you can do so by email at Julian.Scurci@svn.com and Daniel.Miller@svn.com, or by visiting svnpurewestcre.com.